Good afternoon. Thank you for joining our webinar today. Before we get started, I want to go over a few things. The webinar is being recorded, and a YouTube link will be sent to everyone, probably within the next day or two. So if you want to revisit anything or share it with someone else, you will be able to do that. My contact information will be at the end of the presentation, so if you have any questions later, you can reach out directly. We will also have some time at the end of the webinar, the presentation, to answer any questions that you might send in during it. But everyone is in listen-only mode, so you will need to submit those questions by typing them in using the toolbar. Now we will go ahead and get started. I am Cheryl Knurlberger, Senior Account Representative with LKCS. And again, thank you for joining our webinar today about attracting more loans. For those of you who may not be familiar with LKCS, I'm just going to give you a brief background. LKCS has been working with financial institutions across the country since 1961. We provide a variety of services and products, all targeted and designed specifically for financial institutions. And these range across all different marketing channels, from traditional to digital and electronic, as well as our statements and e-statements. It's possible at some point you have experienced a time when your financial institution has struggled with loan growth. But at that same time, we know that consumers in your market are still applying for loans. And it's probably safe to assume some of your own account holders may be applying for loans, but with other lenders. So your lack of loan growth is not from the lack of loan activity. It's getting that activity with your financial institution. That's when it's time to examine how you're currently asking for loans and consider a new strategy. If your current marketing plan is more heavily weighted on the mass media side, then it's probably safe to assume that your loan messages are general and branded, simply creating an awareness that you exist and you have them. Using medias such as traditional broadcast, billboards, general online and social media ads, and possibly mass emails will certainly give you a larger reach. But because of the general message, they are a shot in the dark when targeting and really catching someone's attention. So you're casting a wide net, but delivering the same message to that mass audience. It's nothing personalized. Nothing that gets them to stop and say, hey, that's just what I'm looking for, and I want to learn more. So your current reach is high, but the response rate is low. And if you're able to find a way to measure it and do the math, you'll see that the result is your cost per piece or impression is low, but your cost per response or conversion is high. So it's time to pivot. Time to start asking more loans asking for more loans by targeting the right people at the right time with personalized one-to-one offers. This is how you're going to attract more loans. You'll be delivering specific messages to specific demos with a promotion or offer that's relevant to each recipient who sees it. Now keep in mind that you will be reaching smaller quantities of consumers, but because your offers are much more targeted, your response rate will be higher. Overall, this approach will result in higher cost per piece, but you are going to lower your cost per response. How you do this is by using credit-based marketing. There are two approaches for leveraging credit data in marketing, and both are about getting the right offer to the right prospect at the right time. Credit prospecting is a proactive approach that targets account holders for or prospects with specific demographic and credit-based traits. Credit alerting is a reactive approach that targets account holders who are currently in the market for a loan product and actively applying. Either of these credit prospecting approaches are available for any pre-screen marketing campaigns. You can use it to target mortgages, auto loans, home equity loans and HELOCs, credit cards, auto and mortgage refinancing, student loans, and even personal and unsecured loans. You can prospect your existing account holders or reach out to new credit qualified prospects in your defined market areas. Now, looking at this list, you might be thinking, hey, this all looks good. Let's go get them. But you want to make sure that you stay targeted and have a strategy. That's what this is about. You want to have that strategy and targeting for better results and lowering your cost per response. So it's best to actually determine what you are prepared to handle as a financial institution, and then which slice or slices of the pie you should focus on first. So basically, what are your priorities? So with credit prospecting, you will be delivering pre-approved offers of credit to account holders and non-account holders within your market based on their actual credit score information. You'll select criteria to identify the recipients that will qualify for a loan offer based on your specific pre-screen requirements that are best for your financial institution. And then extend to them a personalized firm offer of credit using direct mail, email, statement marketing based campaigns, and even outbound phone calls to qualified prospects. Now, we'll get back to talking about criteria and offers shortly. But first, what are we really referring to when we say credit bureau data? LKCS has relationships with all three credit bureaus, Equifax, TransUnion, and Experian, and can purchase data from any or all of them. Now, to have a relationship with all three is actually important because not all the credit bureaus have information on everyone. You may have a preference as to which bureau you want to work with, but the truth is prospects and account holders may be shopping with a company that uses one of the other bureaus. So by pulling from all three, you will see an increase of up to 70% in leads compared to just pulling from one. And there are no additional costs to pull data from multiple bureaus. LKCS can also get more data on credit qualified prospects because we can then supplement our credit data using multiple sources. We can include other data points such as credit triggers, demographic information, homeowner and property information from county assessors' offices nationwide, all sorts of automotive purchase information, automotive valuation models, and behavioral models. And even though we can get all of these additional data points, what we really want to talk about today is specifically the credit-based marketing. When we do these campaigns, we are extending pre-approved or pre-qualified offers of credit to prospects based on their actual credit score, history, and information. And you have the ability to set that criteria to identify the people who will qualify for a loan based on your financial institution's specific requirements and lending guidelines. So how does this work? Once you've decided which loan type or types you want to go after, you'll need to set the criteria for each of those. Are you looking for a specific FICO score, LTV, credit history. It's really up to you. Now, we will help guide you through this and even suggest some ideas that we've seen work with other clients, but ultimately it's going to be based on your institution's lending guidelines and what you're comfortable with. So now we're going to take a look at some potential prospecting campaigns. Now, these are just examples, so keep in mind that it's always good to brainstorm about campaigns that make the most sense for your institution and then adjust them as needed. Auto refinancing campaigns are one of the more common campaigns that are requested from us. And the credit criteria may look something like this. Now, again, you're going to adjust it for your institution, but in this scenario, candidates must have FICO scores above 640 with no history of any late payments or repos, and possibly no bankruptcies as well, or at least no bankruptcies within the last 24 months or something like that. We can even include loan payoffs. Let's say we only want prospects that have 2 to 3 years left on their loan. And you might also choose to only consider people who have a minimum balance remaining on their loan, say over $5,000. Some financial institutions also want to set a minimum monthly savings they can show to their prospect. And the way we can do this is from what we already know about our prospects. We can determine what rate they would qualify for with your institution and make a comparison to their current payment to identify what their potential payment savings might be if they refinanced with you. And then that payment savings can be part of the marketing piece for the pre-screened offer as well. Another potential campaign could be a pre-approved offer for an auto loan. Again, looking at FICO scores above 640, excluding whatever derogatory history you might need to choose. Only offering it to people that have no more than one auto loan in the household and have not opened an auto loan within the last 24 months. Then we might send them an offer that lets them know that what their rate might be if they were to go and get a new auto, and even show them payments based on tiered amounts that they might borrow. Mortgage refinancing is also a common target. In this situation here, we're looking for FICO scores between 680 and 720 with a mortgage balance of 100,000 and up. We can exclude FHA, VA, or reverse mortgages. We can also set parameters on the age of the loan and eliminating anyone taking out a loan within the past 12 months. So, and this is to help us eliminate anyone who may have already recently refinanced. We can even look at LTVs. Add in any derogatory history you need to exclude, such as any 30-day late payments in the past 12 months. And payment savings could also be calculated with mortgage refinancing as well. And of course, home equity offers. Again, looking at FICO scores, mortgage balance below $150,000, LTV requirements, and here we're looking at less than 50%, and derogatory history, no 30-day lates in the last 12 months. We also do a lot of balance transfer campaigns, such as credit card campaigns. In this scenario, the prospect must have a FICO score between 650 and 720. An existing credit card debt, let's say over $5,000. We can further qualify the prospect by even looking at their credit card balance to credit card ratio if you want, so we can make sure that they aren't maxing out all of the credit cards they have in their wallet. And again, exclude those with 30-day lates, no bankruptcies, and no collections within the last 24 months. So these campaigns are using just a few of the credit parameters available, but there are literally hundreds of different credit fields to work with. And we can help you go through this process when you are trying to figure out what your criteria is going to be. But keep in mind that you don't want to use too many because this will limit your audience too far. All the prospects you will be extending an offer to will still need to go through your complete application process, even though we're telling them they are pre-approved. So now that we've established the credit criteria and have our prospects, how should we target, or what should the messaging be to get the maximum response? We want to be sure that the offer we send out is relevant to the person receiving it. So, for example, with this first-time homebuyer offer, you want to make sure that obviously we're sending it out to renters that have qualified by FICO score and the other credit parameters. We could send a revolving debt reduction offer to a different group of prospects. This might go out to homeowners with a specific amount of available equity, maybe over $50,000, but they have revolving debt over $20,000, which means they're probably carrying a bunch of credit card debt. So maybe we send them a home equity loan offer that specifically talks about how it can reduce their debt, ease their budget, and the other benefits to the offer. But again, they'll still have to qualify based on FICO and the other parameters you have in place. And then let's look at a similar group of homeowners with that same equity, but they don't have that revolving debt. However, through the other sources that we have available, we know that they have high school age or college age kids. So maybe our message to them might be how their home equity is useful for other purposes, such as education funding. Or we know how long they've been in their home, and if it's been 10 plus years, maybe the message needs to be to this group how they might be able to use their home equity for home improvement projects. So you can see in these last two examples how you can make that marketing message more relevant to different recipients, and this will improve your response rates. So if your goal is to generate more home equity loans, there is more than one potential campaign just by changing the criteria slightly and the other things we can learn about the prospects. So now that we're talking about the marketing message a little more, I want to make sure that you're clear on a few things you need to know when using credit data. We've already been talking about this, but be sure to specify your lending guidelines and only market to prospects and account holders that meet your specific credit criteria. And credit data can only be used when you're extending credit offers. And when you make that offer, you must also be sure to include in your marketing piece everything you need to be compliant with the Fair Credit Reporting Act. And of course, we can help with all of this. Your marketing piece will then be set up with variable data fields, which means fields that are customized towards the recipient's qualifications. This can be rates and terms, the pre-qualified amount, where to apply or the branch to go to, And even a phone number can be changed up on the marketing piece. And some ways to get this offer to the recipient might be using direct mail. And that can consist of postcards and self-mailers. Even personalized letters. That's another viable option to send out to the prospects. Statement and e-statement marketing. So if you have the option of statement and e-statement marketing like LKCS statement clients do, you can also reach out using a statement letter. This is taking the first page of your statement or e-statement to make that personalized pre-screened offer to one of your current account holders. And then this is also a great way to save on postage too. And of course, you can also use email marketing. Now, obviously, email marketing is something that is going to be easiest to use with your own account holders and online banking users because it is permission-based, and the first step is to build an opt-in email list. And just as a side note, from a prospecting standpoint, LKCS doesn't provide email marketing lists. Email marketing is the most cost-effective. It's inexpensive, but not free. It allows direct interaction with your website and more specifically, possibly an online application. And it does give you the option of immediate delivery. You can send a message with minimal turnaround time. With any of these marketing options, you can also follow them up with online retargeting ads. These are the ads that follow you around online and are usually triggered by a specific page visit on a website or some kind of action taken on a website. These ads are then set up to be focused on that same interest. And if they click on them, we'll send them or should send them to a specific landing page. Now, although these ads aren't going to be able to include the specific offer of credit, it will keep your name in front of the prospect as a reminder about that specific offer they received and actually took the time to look a little bit deeper on your website. So now let's talk a little more about what is required when using marketing or when using the credit data. Whenever you use the data, you have to send out a firm offer of credit. You can't send out what we might call an invite to apply. So in other words, you can't just say, hey, we've got great auto loan rates for you, come on in or go online to apply. You must include more specific information about the offer to be compliant with the Fair Credit Reporting Act. So what that means is your marketing materials must include language that the person receiving the offer knows they have been pre-selected, pre-screened, pre-qualified, or pre-approved for a specific type of loan. And yes, we must specify what type of loan they are qualified for. Must include what the minimum amount is they qualify for, and that amount must be stated in the firm offer sentence, such as you are pre-qualified for a mortgage of at least $50,000. The rate, or at least what the maximum rate should be, also included. And the rate can be actually any size and placed anywhere within the marketing piece, but it does need to be included. We need, we need specific terms and conditions. What makes the recipient eligible for this offer and why credit may not be extended after all, such as if they don't have income to support repayment or lack collateral. And remember, even though we're telling someone that they're pre-approved for a loan, they still have to go through your complete application process. And if anything indicates that you would not normally approve them for a loan, you are under no obligation to extend that offer. There are also specific opt-out notices and disclosures that need to be included. These are from the credit bureau and must indicate that credit data was used as part of the campaign and give them the information they need to be able to opt out of those campaigns in the future. So what are we looking at for costs of a credit prospecting campaign? It depends mainly on the number of records you purchase. If you decide to add additional demographic selects from our other sources, such as householding or property information, that can also add to the cost of your list. Some credit bureaus do have a monthly minimum of records you must purchase, so even if you don't purchase the minimum, you're still going to be charged the minimum for those records. And there are also some one-time charges to get the initial setup completed with the credit bureaus as well. So if you have an interest, it's best to let us help you. And if you reach out to us, we can run free list counts and estimates for you to make sure that you have an idea of how many potential prospects there might be and the costs. And once you know the count estimates, then we can go ahead and get you quotes on your marketing materials as well. So the other option using credit data is what we call credit alerting. This uses the credit data reactively. So it targets your current account holders or prospects who are actively in the market for a loan product and didn't come to you first. This way, you can take action immediately to try and keep that loan they're looking for with you. When your account holder or potential new customer applies for credit anywhere, an inquiry is posted to their credit file. These inquiries are categorized by the loan product they are seeking, so auto, mortgage, installment loan, or credit card. And then there are also certain categories of insurance that are recognized by the bureaus also. Your account holder database or purchase list is then cross-referenced daily. And then we receive daily alerts from the credit bureaus on hard credit inquiries for your members and customers, or the prospects that live in your market that applied for this loan with another institution and also meet your specified credit guidelines. And then this way you can respond quickly with the firm offer of credit and get that loan. So first, you want to select which category or categories of inquiries you wish to target. Leads are then pre-screened using your qualification criteria, which will include some of the same attributes we discussed earlier. And then daily alerts come in one file and contain info from all 3 credit bureaus. And then LKCS will provide you with a list of leads and fulfill any direct mail or email offers on the same day. Now, the costs for credit alerting campaigns, it's a little different because it's based on the number of account holders and or prospects screened each month, plus setup charges. And again, if you reach out to LKCS, we can run what's called a free opportunity analysis for you, which will be based on your account holder's credit activity over the past 30 days. This will include the following data: credit activity by inquiry type, state, and credit bureau, as well as qualification rates using your specific qualification criteria. Then from this, you will get an estimate of what you can expect for activity each month based on loan type, which will help determine the costs involved. We can then determine if credit alerting makes sense for your financial institution based on the costs involved. Because credit alerting is not for every institution. It does require some work and follow-up. And if you aren't structured to be able to do the follow-up, then you might not be the best choice, or then it might not be the best choice for you. We typically see credit alerting work best for institutions that have at least 10,000 account holders. Credit prospecting, however, is appropriate for financial institutions of all sizes. So anyone can look further into that to help generate their loan growth. Well, this is the information I have prepared for you today about attracting more loans, and I hope you have found it helpful. I am not seeing any questions that have been sent in right now, but if you think of any later, or if you would like to get some counts or estimates, or get an opportunity analysis, just reach out to myself or your LKCS account representative, and we would be happy to help you. Again, thank you for attending today's webinar, and I hope you enjoy the rest of your week.